Okay, let's unpack this. Have you ever looked at the world's biggest headlines, especially, the ones about global economics, and felt like they're happening in a language you almost speak, but not quite? Today, we're taking a deep dive into some really fascinating material that connects the dots between two seemingly distant high stakes events. We're talking a major gas deal unfolding in Asia, and on the other side, surging government borrowing costs that are rattling Europe. And trust me, the ripple effects are global. They touch everything from geopolitics right down to potentially your investment portfolio. Our mission for this deep dive is pretty clear. We're extracting the most important insights, the real nuggets of knowledge from our sources. We want to show you exactly why these developments matter to you. Think of it as a shortcut to being genuinely well informed, complete with some surprising facts and clear, concise explanations.
Yeah, and what's truly compelling here is how these two stories, while they seem distinct, are fundamentally linked. They reflect a broader shift in, well, global economic stability and risk. We'll explore the specifics of each development, definitely, but crucially, we'll connect them to that larger picture, revealing why these shifts demand our attention and maybe, just maybe, a rethinking of our assumptions.
So let's jump right in. Our first stop takes us to Beijing and Tianjin. Something pretty significant has just transpired there. Russian President Vladimir Putin and Chinese President Xi Jinping met recently, and the diplomatic language was certainly warm, longtime friends, unprecedentedly high relationship, all that. But beyond the headlines, what tangible outcomes emerged from this high-level handshake, particularly in the energy sector?
You're right to look beyond the rhetoric. This meeting wasn't just about, diplomatic pleasantries. It really solidified a major energy pivot for Russia. And for China, it's a strategic long-term energy security move. At its heart, we're talking about two massive gas pipelines. There's the existing Power of Siberia-1, POS-1 they call it, which is actually set to increase its supply to China. It's going from 38 up to 44 billion cubic meters per year by 2025. Then there's the much-anticipated Power of Siberia-2, or PS2. Russia, China, and Mongolia have now signed a legally binding agreement to build it. The aim there is for an annual capacity of 50 billion cubic meters. That's coming from Russia's Yamal gas fields going through Mongolia and into China.
Wow, that's a staggering amount of energy.
Yeah.
So if PS1 is like expanding an already busy energy highway, then PS2 is essentially building an entirely new, even larger superhighway. It's fundamentally rerouting a huge flow of Russian gas. What's driving this? Why is Russia pursuing this new pipeline so aggressively? And why has China, as our sources suggest, been a bit more cautious, almost playing hard to get?
That's a critical question. It's all about motivations and leverage, really. For Russia, this is a strategic imperative, absolutely. They're faced with extensive sanctions, a dramatic decline in gas exports to Europe. They used to be around 170 billion cubic meters per year, huge numbers. So China represents an absolutely crucial new market. It's a massive geographical reorientation of their energy exports, sort of a necessity born from geopolitical isolation, you could say. For China, it's about enhanced energy security. They want to secure stable, long-term pipeline gas that offers a reliable buffer against the price volatility and, well, the logistical challenges of liquefied natural gas, LNG, shipments. Their caution, as you noted, that stems from a desire to get the most favorable commercial terms, especially on pricing for PS2. They've been astute negotiators.
Okay, that makes sense. China is essentially looking for a long-term, direct from the source supply. They want to stabilize their energy future, kind of insulate themselves from global market swings. It's like a large corporation committing to a bulk purchase from a trusted supplier, right? To lock in those better prices. But even with this agreement, the sources indicate that the precise commercial terms for PS2, things like the final price per cubic meter, the construction timeline, they're still being hammered out. Some reports even differ on how legally binding the current agreement is regarding pricing. So how truly solidified is this new energy pivot for Russia if the specifics are still, well, up for debate? What leverage does China really hold here?
That's the million-dollar question, isn't it? And it really speaks to China's formidable negotiating position. By delaying the final commercial terms, they maintain significant leverage over Russia, which, let's face it, desperately needs new markets. China's economic might, its growing demand, it makes it indispensable to Russia's energy strategy. That allows Beijing to push for very competitive pricing, likely at a discount to global market rates, much like they've done with POS-1, actually. And beyond gas, this meeting also saw the signing of, I think, over 20 bilateral agreements, spanning everything from AI to agriculture. It shows broader, deepening cooperation. Diplomatically, the timing was interesting, too. Aligned with the SEO summit, the 80th anniversary of the end of WWII parade, it was strategically used to project a strong anti-Western and multipolar world orders narrative. It's a powerful symbolic display of unity against perceived Western dominance. And that's reinforced by China's announcement of a one-year trial of visa-free entry for Russians, signaling, increased personal exchanges.
Okay, here's where it gets particularly fascinating for me. What about potential roadblocks, external pressures, especially from Washington? Could that complicate this evolving partnership?
That's a critical external variable, definitely, and one that adds significant risk to these projects. The Trump administration has previously warned of imposing secondary sanctions, additional tariffs on countries that purchase Russian oil and gas. China, as the primary beneficiary and partner in these deals, could certainly be a target. If those tariffs were to materialize, well, they would significantly increase the external risk premium for these Russia-China energy deals. That could potentially complicate financing, equipment procurement, and ultimately the economic viability of PS2. This isn't just a bilateral energy deal, it's a piece on a much larger geopolitical chessboard.
So, boiling it down, what does this all mean for you, the listener? Whether you're interested in the markets or just trying to understand global power dynamics and how these alliances are shifting.
Well, from an investment perspective, there are certainly opportunities. Think about the supply chain for POS2 pipelines, compressors, engineering services across Russia, Mongolia, China. For China, the improved energy mix stability could lead to more predictable gas power generation utility sectors. That's a plus. Mongolia, for its part, stands to gain from transit fees and infrastructure investment. However, the risks are substantial. Those unconfirmed commercial terms for POS2, that's a big one. The looming potential for U.S. sanctions disrupting financing and equipment, that's another major risk factor. And, China's own economic slowdown potentially impacting future gas demand. That can't be ignored either. Investors will be watching very closely for any definitive signals on pricing and financing, and of course, any news regarding potential U.S. tariffs. These will directly influence the risk-reward calculation for this energy superhighway.
All right, let's pivot then. Let's go to Europe, where a completely different but equally significant economic story is unfolding. And surprisingly, it shares some common threads with this Asian energy reorientation, especially when we consider the underlying global risk appetite. If you've been following financial news, you might have heard murmurs about government borrowing costs going up. Well, in early September, something truly unusual started to happen. Long-term bond yields in Germany, France, and the UK suddenly surged. We're talking levels we haven't seen in decades. Germany and France's 30-year yields hit highs not seen since 2011 and 2009, and the UK's 30-year bond yield reached a staggering 27-year high. That means it hasn't been this elevated since 1998. That's a major, major move.
Yeah, it's striking. And what's key here is that this isn't merely a localized European issue. Not at all. These surges are deeply connected to a global phenomenon known as term premium resurgence. Let's break that down a bit. Imagine a government wants to borrow money for a very long time, say 30 years. The yield is essentially the interest rate, the return they have to pay you, the lender, for that money. When these yields jump like this, it signals that the cost of borrowing for governments is skyrocketing. Simple as that. The term premium, then, is the extra return investors demand for taking on the risk of holding a long-term bond. It compensates them for things like inflation risk or interest rate uncertainty over that really extended period. Its resurgence means that perceived risk for long-term lending has just shot up significantly. Think of it like going to get a car loan, and suddenly the interest rates the bank offers are much higher than last year because they're worried about the future. For governments, this makes everything from public services to new infrastructure much more expensive to fund.
That's a really clear explanation. Thanks.
Mm.
So we're not just talking about higher interest rates generally, but a higher premium specifically because of uncertainty over the long haul. What's creating this perfect storm? What's pushing these borrowing costs up across Europe and, beyond?
There are a few key drivers really converging here. First, sticky inflation. Okay, inflation has come down from its peaks, but it's proving more persistent, more sticky than many expected. For example, the Eurozone's August inflation was 2.1%, just slightly higher than forecast. This makes lenders demand a higher return. They need compensation for their money, potentially losing value over that long 30-year period. They're demanding that extra term premium to protect against future price erosion. Second, central banks are strategically stepping back. This is a big one. Major central banks like the European Central Bank, the ECB, they're no longer acting as massive buyers of government bonds. The ECB, for instance, stopped reinvesting maturing bonds from its big pandemic program, the PEPP, at the end of 2024, and is continuing to reduce its overall bond holdings by about $40 billion a month in 2025.
What this means is a significant source of buying power has just been removed from the market. Imagine a major, consistent buyer at an art auction suddenly withdrawing or only making very low bids. What happens?
Prices go up for everyone else, or in this case, yields go up.
Totally. Bond yields will naturally rise as there's less demand soaking up the supply. Third, there's a flood of new debt hitting the market. Governments across Europe are planning to issue significantly more debt. A lot more. Europe is expecting roughly $100 billion in additional bond issuance in September and October alone. That's a huge amount in a short time. The UK, for its part, announced plans to sell $299.2 billion in bonds for the 2025-26 fiscal year. So you've got more supply of bonds, coupled with less central bank demand. It inevitably pushes yields higher. It's basic supply and demand, right? If suddenly everyone is selling apples at the market, but fewer people are buying, the price of apples goes down. In the bond market, when there's a flood of new bonds that supply and less demand, the price of the bond goes down, which directly means its yield, the return for holding it, goes up. And fourth, there's local and global instability. Local factors definitely play a role. Things like political and fiscal uncertainty in France have widened the spread between French and German bond yields. But it's also deeply connected to broader global trends.
Long-term U.S. Treasury yields are nearing 5%, and that acts as a powerful global anchor. Even Japan's long-term bond yields are rising as their central bank normalizes policy. All this creates a global upward pressure on long-term borrowing costs everywhere.
Okay, so this isn't just Europe's problem then. It's intricately linked to what's happening with the US, with Japan. How does that linkage specifically work? And what are the direct implications for, your investments or even just for understanding the global economy day to day?
It really is a global phenomenon. The New York Fed's data, for instance, shows that the term premium for U.S. 10-year bonds has risen to its highest level in 2025. When the U.S., which is the world's largest and most liquid bond market, sees this risk premium rise, it acts like a magnet, pulling up long-term yields globally. Furthermore, Japan's central bank, the Bank of Japan or BOJ, is signaling further gradual tightening of its, ultra-loose monetary policy. This causes Japanese long-term bonds, JGBs, to hit record highs. This policy normalization affects global capital flows. It potentially makes Japanese institutions less interested in buying U.S. treasuries, which then further weakens global demand for long-term bonds, putting more upward pressure on yields everywhere. It's all interconnected. The direct impact for your investments is profound. Traditional strategies, like having a simple 60-40 mix of stocks and bonds, they might not work the same way anymore. The positive correlation between stocks and bonds has weakened. That means they might move in the same direction more often, reducing the diversification benefit you once relied upon.
Wow, that's a fundamental shift, isn't it? Reshaping basic investment principles we've held for a while. So for us, the everyday learner just trying to make sense of our financial world, what's the ultimate takeaway from this whole bond market upheaval?
I think the key message is that we are decisively moving away from an era where long-term government bonds were seen as a passive defensive asset. Something you could just buy and hold for perceived safety and reliable returns. That's changing. Now, you likely need a far more active and nuanced approach. This term premium resurgence across the U.S., Europe, Japan, it means the cost of borrowing for governments is structurally higher, period. And long-term interest rates are going to be significantly more volatile. For you, it means recognizing that the cost of debt is rising across the board and understanding that global events are more interconnected than ever. They directly impact everything from government budgets and fiscal policy right down to your investment portfolio and the future cost of capital.
Wow, what an absolutely insightful deep dive. Seriously. From the intricate energy politics reshaping alliances between Russia and China, to the complex interconnected web of global bond markets and this rising cost of capital. We've really seen how these two major stories are fundamentally shaping our world right now. It really highlights how seemingly distant headlines have a profound and very real impact on the global economy and, potentially right on your wallet.
Indeed. And this truly raises an important question, I think. In a world where these global economic anchors are visibly shifting, where traditional investment rules are being fundamentally rewritten, how will you adapt your understanding of both risk and opportunity? It's no longer just about what's happening in one country. It's really about how all these powerful forces intertwine on a global scale.
It's a moment, certainly, to reconsider what true stability looks like in today's global economy. We genuinely hope this deep dive has given you some valuable nuggets of knowledge to chew on, and perhaps even inspired you to keep exploring these fascinating and crucial connections. Thanks for joining us for this deep dive into the forces shaping our world. Until next time, keep learning, keep questioning, and stay curious.